Money at Work series. Today on the Money at Work series, we're going to be discussing basic terminology for beginner investors. It's just some basic language that you need to know and understand when you're putting your money to work. First thing we want to look at is ROI. ROI is short for return on investment. ROI is a simple measurement that refers to the gain or loss experienced relative to the amount invested and is often expressed as a percentage. ROI is calculated by dividing the gain or the loss by the cost of the investment. So for example, if you put $100 into an investment, the investment is now worth $400. You quadrupled your money, which is a 400% ROI, or return on investment. Second thing we want to talk about is compound interest. Compounding means that when interest is initially calculated on the principal amount that you invested, the added interest can also earn interest. And this is very important. Compound interest is a fundamental component of wealth creation. Imagine earning profits on top of profits on top of profits as you let your capital grow. Einstein called it the eighth wonder of the world, and Warren Buffett consistently praises the concept. If you want to get rich, learn about the power of compounding. Next is liquidity, the ability to cash out of investment easily. Cash in your checking or your savings account is the easiest to access. We call that liquid cash. Money in investments that need to be sold before it can be accessed, and it takes a few days for the trades to settle and the cash to become available, can be problematic on a number of areas. If you need the money immediately, you have to wait. And also, if the market is unfavorable at that time to your investment, you could be forced out of a position at a time when you didn't want to make that trade. Liquidity in the stock market means there are ample buyers and ample sellers, where if you try to enter or exit a stock or a position, you'll be able to get that order matched without getting a bad price. Next is diversification, an investment strategy that is in effect avoids putting all of your eggs into one basket. Using this strategy, investors have a variety of investments such as stocks, bonds, money market funds, etc., to minimize the risk. The downside of diversification is that often the bulk of your capital won't be placed in the highest performing assets. Instead, you'll own a little bit of everything, so the rate of return might not be as high in certain periods of time, but you also shield yourself from market risk by diversifying and getting yourself out in many different asset classes. Next is bear or bull market, and this is very simple. This is a common metaphor used to describe the investor environment primarily related to the stock market. So a bear, sort of want to envision the bear as swiping its paws downward. That indicates a downward market, lowering of stock prices, investor pessimism, and simply a lack of confidence in the market. On the other hand, a bull with its horns pointing upward indicates investor optimism and confidence, as well as a rise in stock prices. And then finally is buy or hold. This is a type of investment strategy where investors buy stock and hold on to them using the philosophy that long-term gains will provide a nice return if they're invested into a solid company. Buy and hold investors generally disregard short-term market volatility and are often looking to buy bargain stocks in market crashes or declines and hold on to those for long periods of time. Want to know more? MillionaireMindset.life will give you information about investments, retirement, Money 101, the mindset of millionaire thinking.